Hello and welcome to this latest roundtable in conjunction with NORD and Themis Foresight, a European leading think tank. Today we're going to be talking about the findings from the latest report from these two fascinating entities where they've really started to dig into and look at the future of the European capital markets. Fundamentally, where are they going? What are the state of play for the markets over the course of the next 5 to 10 years? And what is the path forwards to unlock future investment in this key area? Joining me to discuss the findings of the report and more, I'm delighted to welcome Jan, Martin, and Heiko. Gentlemen, welcome. I guess to kick us off, what I'd like to do is start really by calibrating our thinking and starting to think about kind of like where this all began, because on the sort of the surface, at least, the future's rosy, right? You know, we're seeing projects coming through the market. We're seeing developers bringing projects to banks, to lenders, and we're seeing some strong assets hitting the market in construction and operation. But what I'm hearing from you all as we look at the findings of this report is that actually something's amiss, and that something is being held back, and perhaps that's a little counter to what the rest of the market is saying. So can I just perhaps start, maybe with you, in terms of that sort of fundamental question, what is holding the European capital market structure back, and why is no one else seeing this?
Oh, plenty of people see it. Let me take a half step back before I go into what I perceive as the two biggest factors. It's the question of what level of ambition do we want to develop on this issue? European industry is hurting from really high energy prices right now. So if we want to go towards green energy, we need to bring the prices down. That means a lot of investment. So apart from, risk aversion, overregulation, all these things, the two biggest factors that we identified are, number one, the structure of the capital market, where banks roughly make up 65% of the assets, and the rest is the asset management industry, some public holdings, because they are regulated. So it takes a while to roll over capital. So it's not to take a cheap shot at banks. There's a good reason they're regulated, but asset managers aren't moving as aggressively into the market as I would like to see. That's number one. And the second is there is the fractured landscape of the European capital market with 27 different capital markets regulation really is an expensive price to pay. So you have to think about this issue on a pan-European scale.
Plenty to think about within that, Jan. But Martin, can you just pick up on that point that Jan was making with regards to the fragmentation of the market, and specifically kind of why has that European market become so fragmented from your perspective?
Well, first of all, I don't think it has never been really fully integrated. So I guess we are having a historically grown structure in the market, and we have got all these, let's say, vested interest in those markets that are holding us back. And what are the kind of mechanisms that one should point at is capital markets really strive with standardized products, so that everyone knows that what I'm looking at is exactly what I should be, what I'm getting. And in a fragmented market, that's not the case. And therefore, it is really holding back investment. It's also quite, let's say, straightforward to compare that to the US market, at least in these type of projects. These are usually taken up when they have been constructed by long-term investors. There are quite a couple, also actually American investors on their way here in Europe. And therefore, the bank's balance sheet is not that long, if you want, or it doesn't hold the asset that long on its balance sheet.
So just to be clear then, if we compared the European markets with the US market, from your perspective, do you think that standardization or that sort of evolution towards a more standardized sort of set of investment metrics is perhaps is that delta kind of closing or increasing between when you look at sort of the US, Europe?
I think at the moment I would say it is certainly not decreasing, is not closing. Yeah, I would say if anything, it is widening the gap between the two. But again, it's not only banks; it's also the other people or other institutions that are busy in the capital markets that, if you want, need to step up. But just giving a very simple metric here, right? If an US bank finances these projects and there's like this 15, 18-year funding required, and after 3 years after the construction phase, it's taken out of their hands.
Yes.
So that they can redeploy the capital that they had actually absorbed in that project into the next project. In Europe, that might be those 15 years. So basically, you would need, just on that very simple calculation, you need 5 times the bank capital to get to the same number of projects. So that gives you a little bit of an idea as to what the difference and also competitive is. Yeah, in that sense.
Can I perhaps, Heiko, bring you in at this point, particularly in terms of, I guess, picking up on what Martin was talking about in terms of that 3 to 5 year kind of recycling of capital. And I know we're going to come on to that in just a moment. But when we talk about this, so when we put it against the context of fragmentation within the market, I guess what I want to understand is how that very well-defined period is stopping those funds from moving into these markets. Like, what is holding them back? Because that is a defined methodology, isn't it? That's something that they're familiar with in other markets.
I guess it's the tenor and how long a banking market is financing those projects.
Okay.
And if you compare simply the US with the European landscape, that you very quickly one will see that the European banks fund those projects long. It always has been like that. Lately, it has come down a little bit, but there's a fundamental change. There's no fundamental change visible on the horizon. And that, as Martin rightly said, slows down the amount of time you can recycle your capital. So they are actually quite flexible, particularly when needed to be flexible in the construction phase where drawdown schedules, the whole funding needs to be flexible.
Yeah.
But they're not the right, let's say, parking space for the longer run when those projects are de-risked. And after the de-risking phase of a project, usually 1 or 2 years after construction completion, in a more integrated, maybe even more efficient capital marketplace like the US, institutional investors or any other parties come in and take those projects away from banks, refinance, and banks can redeploy that capital for new projects to be built. And I think the lack of consistency or the lack of an integrated market is also on the asset side. I mean, Martin, you said it's almost like 27 different bigger, medium or smaller capital markets in Europe. We also have that on the asset side. Like every jurisdiction has its own support system, supports the asset in a slightly different way, which makes it a bit more tough for the investors to kind of define their appetite. They have to think 27 times in what market they would want to deploy their capital there at.
And so is that just to be clear, is that the reason why that appetite is so low? Is that the sole if we were going to put our finger on it?
It's not a sole reason. I mean, there's another, I think, quite fundamental difference between the US and the European markets. If you look at the US, I haven't heard that many solar projects are actually started in Montana or Maine, for what I know. So they start these projects in Arizona, in Texas, and California. So these seems to be the kind of locations. Why is that? It's because solar, for example, is much more efficient in those kind of locations. So in Europe, that competition between what is the most efficient location for a project and where it should be built and which should get, if you want, the investment first, is then kind of blurred by the, if you want, national boundaries.
It's done on a national level. This is a national level out of a national interest. So again, 27 times you have that decision, which on a national level allocates potentially those projects between north and south, but not as a complete European, from a complete European point of view.
Exactly. The north has the saving quotas, and then the south has the sun, right? And that's what needs to be calibrated through the market.
And I would venture that a more integrated capital market would put the pressure on that kind of topic too.
Are there examples in the past that we can look at with it outside of the world of renewables where we have seen that kind of that initial the sort of the path that we're following, where we look at infrastructure from a renewables perspective and through a renewable lens, can we look to other parts of infrastructure over past decades? Is there a point where history would kind of teach?
Gosh, I mean, there's the long discussion Spain and France have had about connecting the Spanish gas system to the French gas system. Yeah, it doesn't help. It's again the same thing. So basically, it's very natural because Spain had, when Corona hit, and also then Spain had the access with the LNG points for us. And this kind of, if you want, national priorities, they are set. We're certainly holding us back. Yeah, it certainly also leads to, let's say, less productive decisions.
Yeah,
between the two of the factors in this case.
So before we move on to sort of to that element around sort of European capital market and sort of the structure of the framework, I just want to be dead clear in terms of that risk appetite for the investors. Then, so what we're saying, what I'm hearing is that look, you've got that sort of 27 different states and kind of the view or kind of the fragmentation of that. That's presumably hard for those investors to kind of sort of start saying, well, how do we take a considered view over perhaps more than one or two markets and kind of where we're going deep. And we've also got this challenge with regards kind of how to unlock consistently through cross border. Is there anything else that we really need to perhaps understand, or kind of certainly from a banking perspective, be aware of in terms of that kind of that engagement and that education with those investors that's going to be key to this upfront? Jan, is there anything that came through in the conversations that we need to...
Martin already alluded to this, and as did you. A fragmented market, but sort of more involvement of the asset management industry in national focal areas. So let's say, the French or Polish asset managers become very active, and then, sort of get a very national competition. Possible, it would certainly relieve the banks, and you would only have to increase the capital by 166%.
So it's bringing it down.
It's bringing it down, which was kind of the point. You involve the asset managers, after the construction phase. Problem with that is that could be poison to the energy markets, because energy also needs to flow from, say, France to Germany and back. Don't want to reopen the whole Swedish-German discussion. The clear energy. So in many ways, the optimal scenario is one where you have the capital markets union and you have the high involvement of the asset management industry. That scenario we call the Great Reform. It would certainly alleviate the pressures from the banks. Still, the banking sector would grow by energy assets by a whopping 130%. And perhaps the most realistic scenario under current circumstances is one that we call the capital market of two speeds, where, let's say, a group of countries, France, Germany, others, sort of form a smaller or core capital markets union and advance, and then let others join once the success is visible.
It's also to this.
Yeah, to act as a capital. There was a French proposal for that, and I think it's a very reasonable proposal, because it does take some time to negotiate among 27 member states how such a CMU would look like.
And just on that, with the French proposal, where did that come about? Was that 12, 24 months ago, Marty?
Well, I think it was about that time frame.
Yeah, and the reason that what held it back at that point, just to sort of...
I guess that's wasn't very popular in Germany, I guess, at the time. But I think that's one of the problems with that. But I guess there was not enough pressure yet. Behind that is a couple of things that I think are worth mentioning. At why is that really so important? Let me get to that. We talked a little bit about we have to make the investments in the most productive areas. It is not a coincidence that, for example, the Dido report, but also in some of the other reports that came out, that they were particularly concerned about the fact that there are not that many really high-yielding, or if you want, attractive investments in Europe enough, because that's why Europe sent a lot of money to the US, right? That's to the tune of $300 billion a year. So there's quite a And we actually really need that money. So that's one aspect. And there's one other, I think, feature in renewable energy that makes it kind of different to the traditional oil and gas, and which also makes another parameter very, very important in this whole consideration. And that is that if you look at the costs between the capex and opex in the renewable energy, if you want infrastructure, great. That's 90% capex, and it is only 10% opex. In the traditional system, it's more like 60-40.
Yeah.
So that means if you want private companies that are busy in that area, when you look at the balance sheet of traditional oil and gas companies, they have a very solid balance sheet. This has to be more so. And that also hints at a really very important parameter, which is the interest rate. That is the financing cost that need to be paid. And all of that is negatively affected by the fragmentation and doesn't help to actually get the capital to the most efficient place.
Okay. I think we should go one step back again to tenor, because I think those scenarios would probably indicate that they'll find ourselves realistically somewhere in between. Yeah, it will not be the great reform, but we're probably in between. The question around why Europe sends so much money, especially in this, let's say, financing of renewable energy projects over to the US, it's not necessarily because the pricing, the yields are much higher. It really is the fact that you can deploy your bank debt approximately 3.5 times at the same time you would have to employ it in Europe for the tenor of a project. The typical tenor in Europe is 15 years to 20 years. In the US, it's between 5 and 7 years. So you have factor 3. And that gives also, I think, the answer to Europe. If we could, in Europe, change the system towards shorter bank debt and a more and greater involvement of the asset managers, the institutionals, then we have that factor 3 in any solution within your 4 scenarios could work very quickly by just reducing it. But it's difficult, because I think from a project sponsor's point of view, that appetite to give longer bank debt is a value. They wouldn't want to, our clients wouldn't want to take this away unless there's a very attractive, for them, an attractive alternative model to refinance their projects and to finance them initially by a much shorter tenor of 5 or 7 years, and then going into this refinancing risk. But I think there is a way around that if we look into the value it really offers, which is flexibility. Ownership changes, or also the different ways of how you can bundle those assets together, require flexibility, and that flexibility with shorter tenors is given. And as such, there could be a value for the sponsors to buy into this model. And your point about a core group in Europe moving ahead faster, I think the same really, and we have to look into the support systems. It's not just the capital market, it's also how Europe supports those projects. And I think talking about a little bit how sticky those tariffs, which have a subsidy type of character, how sticky that is and how difficult to change, because we have real-life activities like whether it's storage. It's interesting that battery storage just starts to become a real big factor in Europe. And it has been much earlier employed and built out in the US. Whilst the support mechanism, the support for this kind of storage, which helps a lot with the problems that come with renewable energy, has been early understood, but also supported much earlier in the US. And I think that's where we need to kind of also think, how can Europe become faster in supporting that activities that the transition needs? It's not just a production. I think for too long, too much money, and still too much money is going into the pure production and not the other infrastructure assets you would need for the net zero transition. The grid, and instance, grid alone over the whole of Europe. I mean, to build a integrated European grid, we probably already 10 years late. Those ideas have been on the table long and haven't really been taken up.
But if you look around the market and you kind of look at that kind of, we talked about so the potential within the French markets on kind of like how they could kind of take the lead on the sort of the progress of kind of that capital markets union, etc. If you look at the role of policy, and I think you used the word sticky, the stickiness of those policies, we're seeing in many respects kind of the benefit of that at an individual country by country level. Energy storage within the UK, as we sit here today, is probably timely to talk about. That has got a strong policy framework, and you are seeing progress off the back of that, as you did in Scandinavia within hydro. And at the moment, certainly there's this challenge with capacity and the need to be able to put energy storage projects against those political projects in the Scandinavian market and Nordic market. So I guess really that what I'm hearing is that it's the engagement from it's understanding of policy and understanding of kind of the stickiness of it, which I think is a great way of kind of thinking about it, Heiko. But it's also about the engagement of asset managers within country and within region to sort of to understand their needs and kind of help them drive that agenda, right? And to sort of recycle that capital and to grow that. Is that what we are? Martin, you've talked a little bit about kind of the importance of that European capital markets union. Is that the sort of, when we talk about how, is that the way that we can see this progress as a union? Like, are we going to see regional pockets of progress that will start working much more collaboratively together? Or how in practical terms is this actually going to unfold?
I guess it will really unfold even in bilateral agreements.
Yeah,
in some cases.
Yeah. So agreement by agreement.
Yes. So that would be my hunch, because I think a big human change, like a directive that basically does that, is to address so many, let's say, political hot potatoes, which are very difficult for me to see right now. But there are other things which you can go a little bit, if you want, slow, but at least if one consistent, which would, for example, be the question of having that standardized contracts.
Yeah.
Having standardized ways of, if something goes wrong, bankruptcy proceedings. So I think so that people can rely on, okay, if this goes wrong and it needs to be kind of restructured, we know exactly how that will work, and it will be almost the same in, let's say, northern Italy or in Sweden. And I think that those are the kind of things you might see actually happening. Again, slowly, but they will be happening. They're quite important too in that context, and that's how I would guess that will happen. There's another aspect which is being discussed every winter, which is, okay, how much energy did we actually import from X, or did we export to Y?
Yeah.
And these kind of discussions have, or if you point towards the fragmentation and also, of course, you have to keep a lot of knowledge about these specifically about, what's the special relation between Germany and the Czech Republic, for example. And so I think all those things are not helpful, and all those things I will think will be addressed, and it will not be like a little big bang kind of approach. I think, at least I can't see it right now.
Heiko, can I just get your view on that pick up on that comment Martin made with regards to standardization of contracts and kind of, I guess, the role that the banks can play within that? From your perspective, when you're undertaking those framework agreements and working, on the ground, often quite literally with those developers, like, to what extent is that, you will have at the back of your mind, for sure, like, if we can create that standardization, then absolutely we're going to be driving longer term deal flow through. But at the same time, project developers, the individuals that are bringing those projects to market, they're going to have their unique set of challenges and their unique set of
on these markets, in the risk environment. And I think standardization on the finance side, to a large extent, has already been achieved. I mean, big projects being financed in the project finance scheme. But I think the complication and the complexity really drives in what jurisdiction do I have that project? Do I finance that project? How is it supported? And exactly like Martin said, what's the bankruptcy laws? And what do I have to... And I think that makes it much more difficult for the capital market players to invest and provide this great takeout. And that's easy in the US. They have a very, very different system. They have a tax incentive. Yeah. So it's not so much looking into currently, a good point. That, by the way, is something we should really discuss, because we have seen short-term disruption to the whole path of building out renewable energy and we've also seen over the years many times that people have had doubts or we have been slightly derailed. But what we have also seen is consistently coming back. Yeah, as a little bit of a sidekick we should really discuss. But no, you're right. I mean, look, the question around standardization will have to also be kind of motivated from the support side. And again, those systems are as different as they are today. Standardization will be very, very difficult. The last time we've seen something like a standardized contract was the UK PFI sector, where there was really an agreement how those contracts on the asset side provide a level of standardization, which, by the way, has fueled and has increased the speed. On the European level, it's hard to believe that this could happen very quickly. So I think we probably need to go back to the question around tenor. If bank debt is shorter and institutional debt comes in, then we can achieve this factor of 3. But then we have to ask the question: how could it be attractive for institutionals asset managers to invest? Because those assets, in theory, should be really attractive in terms of longer term obligations. And what better than to invest in infrastructure, whether it's renewable or general infrastructure.
And can I just, while we've got you on this one, can I just have a few more words, please, on tenor? You know, we've talked about that sort of optimum tenor being, I think you're saying 36 months, 3 years?
No, I think in terms of the US model, it's anywhere between 3, 5, and 7 years.
Okay.
So many projects are being refinanced shorter, 3 or 4 years. But if you look at 5 to 7 years, that's exactly the factor 3. If you compare it to various European markets, where the tenor for renewable energy projects for the bank that is 15 to 20, up to 20 years or even longer. And I think that factor 3 is there. You can see it, right? I guess we see in the infrastructure activity around digital assets, where it's a slightly different play in terms of contracts. We see that the tenor for project finance, which, by the way, does still finance most of those assets as a financing product, the tenors have come down to levels between 7-10 years.
Yes,
which is much closer to the US model. So it's possible. But it would also mean that the sponsors would have to be motivated, because if somebody offers you 15 or 20 years, it's a great product. It's a great product if you know you don't have to refinance after 5 or 7 years.
I mean, it eliminates a lot of headaches in that respect, doesn't it?
It's the same like when you mortgage your house. You want to go for 2 or 3 years or 20 years, right?
Yeah. Can we just come on a final point on that? But I think before we kind of look at kind of that diversification of the base, we can't, as we sit here today, avoid that question of the fact that this is being recorded on the day of Trump's inauguration, and there has been plenty of talk with regards what happens to the tax incentive in the US, which obviously is an act of Congress, etc. So, but that has been fundamental to that investment strategy and kind of the development strategy in the US. And I know that we have been comparing that European and North American structure and strategy. Heiko, you know, I'm going to come back to you on this because you ground it in the kind of listening to what those project developers are saying as on the ground, country by country, and you can see that portfolio moving through. So, you know, is that the sort of message that would resonate with them? They see the opportunity and the path for growth. I guess, do they understand that need for a new capital allocation model, and how can they work with you?
That's a very good question, because I think we don't want to educate our clients. Not our job to educate our clients how they wanna finance their projects. They need to look what's available in the market. We can help them. That's our service, to find the best possible structure.
Absolutely.
And over the long run, I think looking forward, if and we talked about the report really has a great summary about the enormous amount of capital that's needed and how that compares with today's volume that is employed.
Yeah.
And if we would find ourselves very quickly, despite the day-to-day politics and the skepticism we see worldwide. And by the way, over the last 10 or 15 years, we've seen this many times and we've always gone back. So I'm an optimist in that respect for Europe and for the North American market in particular. But I guess the situation, the scenario where we would find a market that maybe has not enough supply of capital, debt solutions. Yeah. You want to avoid that. So our clients are smart. They usually know which way this is going. And if the system needs to change over the long run to make sure that they all have a sufficient supply of financing alternatives, they would be happy to go with this change. I think it's about really to explain that having longer term debt almost to the end of your project life cycle is just one component. And I think there are so many other activities that need to be considered. It's not just the production side. We have the grid, we have storage, we have the whole question around hydrogen, which has been a roller coaster for this narrative over the last 2 years. And I think all we need is clarity and also stick a little bit with the facts and reality, and this will sort itself out. But it's just one other component that needs a massive amount of capital.
Do you see the role of green hydrogen as fundamental to this?
In the long run, yes, absolutely. I think what we have to avoid are those short-term boom and bust movements, and I think that's also sometimes fueled by the need to educate what really needs to happen and at what point in time can it become meaningful and what kind of support does it need. Yeah, I think if you look back in history how successful Europe, particular countries like Germany, Denmark, but also the UK have been in the early days of employing renewable energy, wind power, whether onshore, offshore, but also PV in Europe, how successful to kick off that industry. We have to probably learn and go back to those times, but don't just, then we are back at the stickiness. Yeah, absolutely. You have to have the courage to take the tariffs maybe away, change them to a more market-based system and put the direct support, the more subsidy type of support to those activities you really wanna promote, and maybe also be a bit less directive, a bit more let the market sort it out.
Absolutely.
Let the market sort and find a technology that works best rather than direct the market too specifically towards a certain technology. And as we were talking before about the question, is this now a time of real danger for the renewable energy build out? One element, I don't even know, Jan, a question to you, if I may. Yeah. The $315 trillion needed to achieve net zero. Does this actually already take into account what we now see over the last few years, the growth of demand from the digital space? All these data centers we're also financing because there is this demand. Yeah. They have one thing in common. They have an enormous appetite for energy, but for green energy.
Right.
Yeah. So I wonder whether that extra demand and extra demand for capacity is already in that 215 trillion, or do we talk about that to get to net zero plus the so-called digital revolution that has not been even yet taken into account?
It's partly in these figures. Now, before we get too excited about the energy demand prediction for the digital industry, let's take into account two things. Number one, all the past projections of energy needs in the digital space have been wrong, severely wrong, because they never accounted for innovation in chips or in actual physical compute. And the physical compute has become so energy efficient that's number one. Number two, just the latest figures coming out of China, the Silicon Valley can work with, the absolute high-end chips. China can't at this point. So they're becoming very resourceful and inventive, how on old chip generations you can actually have the same output. Again, tremendous energy savings. And the third point I would like to make is currently the thinking in Silicon Valley is just, throw more data onto already existing data and that way grow. But at some point, the law of diminishing return kicks in. And it costs several more to just get a 2% increase. That's not a very sustainable model, even from a business perspective. I'm not talking about environment here. And so what these guys need to do is, come to terms with the fact that information cannot be separated from physics. Some people have started talking about the possibility of an AI winter or the next AI winter in the next 5 to 7 years. And I would see, I'm not a prophet, but I think it's a possible scenario, and so we have to also figure that in. So,
thank you, Jan. And I'm aware of time. I know that we've covered a great deal, and clearly all of this is unlocked in the report, which is available to download with the information on screens now. I suppose, just to sort of perhaps recap, what I'd like to do is actually just go around the room briefly and capture two things. I want a level of optimism for the or lack thereof for the European markets over the next 5 to 10 years, please. You can give me a scale of 1 to 10. Maybe that's 10 is the most optimistic and 0 is, I'm really not holding my breath. But I'd also just like a sort of a view of where you think the biggest opportunity is that this report kind of like zones in on, that if we work collectively on, we actually have the best possible chance to be able to unlock. And Martin, would you like to go first on that?
Yes, of course. I think I'm quite optimistic for the European markets. We know that what the challenges are, and they're very straightforward solutions. But we shouldn't forget that Europe, as opposed to the US, is financing. So we do not need to ask third parties as to get the financing that we need to power for the projects that we want to pursue. So in that sense, I'm optimistic. I would say make it 8.5 out of 10.
8.5.
If that's possible.
We'll take a half. We'll take a half final now, boy.
Excellent. So the second question was on the areas. The areas. I would think that if you look at the critical path of what is the highest impact investment that we can make, there are probably two parts of that. One is Heiko was talking about those, which is the grid. So it's not only about the production of the energy, but it's really like the grid around it. The other technologies that we should use. I mean, a successful society, if you want, at the end of the day, uses the technology that's available to itself, to the great extent possible. And I think that's really the challenge that we have there. That's one. And I think the second part is really with a more integrated market, or let's say with more integrated thinking, right? That at a societal level, it becomes clear that, solar comes best from Southern Europe.
Yeah.
Wind is more like a Northern Europe kind of thing. And that then, if you want, gives you the design for the grid, the common grid that we need to kind of build. I think that's where the greatest opportunity lies for Europe.
Yeah. We can start with a number. We'll allow half points.
7.5.
7.5. We've started the trend. Okay.
No, I am quite optimistic, but I'm coming at it from a different angle. So I'm mixing both questions here. It used to be that we looked at the question of European integration on a left-right spectrum, and that doesn't work. I mean, you've got Mélenchon in France and BSW in Germany. Left, if you want to say, parties who are very Eurosceptical. At the same time, Viktor Orban made sure that Romania and Bulgaria get fully integrated into Schengen. So I actually also see in the conservative right in Europe strong integrative tendencies.
A 7.5, an 8.5. Heiko.
A straight 9?
A straight
So
9.
I have to be, and I'm an optimist by nature, but I also have to be, we've built a complete franchise around this narrative. The whole project finance activity of NORD is with regard to renewable energy and digital infrastructure. Those, we've just explored that earlier. Those two parts are also very much connected. And I believe we have very smart clients in Europe that have mastered their growth and success over many, many years in a fragmented but also sometimes very challenging landscape where policies weren't consistent. It stopped, it went forward again, and I think they've learned and they've educated themselves. And I think we have also companies from both sides of the Atlantic investing in the other areas, in the other locations. So the pendulum always swings, and pressure is good. If Europe at the moment feels that pressure for more consistency, for making a smarter model around support, how to support those various activities in the renewable or sustainable space, that pressure is good, because pressure leads at the end ultimately to more thinking and maybe smarter solutions. And I think last but not least, the European banks are also there. Collectively, they have the capital. If we can bring the tenor down and operate around this factor 3, we can make this work. And as much as the European banks send investor money rightly in the North American market, overall, I think the funding is there to help that sector to continue to grow.
On that optimistic note, I'm going to draw this to a close. So thank you all for joining us for this discussion today. And it goes without saying that if you would like to read a full copy of the report, you can do so. There is a link on the screen now, or do get in touch with a member of the team. Thank you for joining us.